All right. What is up, everybody? Happy Friday. Welcome to this AMA live stream. Wanted to kick these off for a couple reasons. But ever since we did come out with the book, since I wrote the book, Unlocking Millions, the ultimate guide to investing in real estate with the HELOC, we've just gotten a ton of questions. And some of them I try to truly get to all the questions that come through via email, through the YouTube channel, etc. But it's a little difficult to do so, just being completely frank and honest. So I thought, if there's an opportunity for me to kind of answer maybe some of the questions that I get more frequent with a live audience, then maybe that would be helpful for multiple folks and just get lots of questions answered more efficiently and just go about it that way. So that's one of the reasons as well. Also have some time open in the schedule Friday mornings now. So thought, hey, let's check this out and see if it works. I know lots of people, are working. This time is hard to catch. So the intent of this session is, all things real estate. Any questions you guys have, instead of the text, emails, or calls for, hey, can I pick your brain for 10 minutes? This is a much more efficient use of my time, and hopefully you'll be able to educate some of the other folks in a similar position as you, or may have the same questions. So with all that, let's go ahead and dive in. We'll talk a little bit about the real estate market in general, what things are looking like, a little bit about some interest rates, and then jump into HELOCs as always. So I did have a couple of you guys shoot your questions over via email because you couldn't make it this morning. That's totally fine. If you are watching this after the live stream has ended and you want to get your question asked, go ahead and just drop that in the comments below. We'll kind of move that to next week's agenda, or make sure we get that question answered for you too. So I want to kind of just create this community of getting all of your guys' questions answered. But the thing that I guess wasn't super apparent to me when we did write the book and try to really put all the answers to your questions out there is, that really helps from a fundamental standpoint, to get the understanding or the foundations explained. But everybody's situation and goals are unique. So it's really hard to answer a specific question without truly understanding your background and what your goals are. Some people have goals to lock up a property, flip it in 30 days, and some people want to buy something that they want to hold in their family trust for the rest of their life. So obviously, with different goals, it's a lot more difficult to give you advice. And quick disclaimer on the subject of advice: nothing that you hear here today or ever on my channel is specific investment advice. Always reach out to your tax professional, investment professional, or advisor before making an investment decision. My intent is to really just give you guys thoughts, or a foundation, or a lens of which to evaluate a current situation through, and hopefully help just kind of provide context from that perspective there. So with all that said, let's start off talking about the real estate market in general. So lots of folks have reached out to me, just watching the news, all the negativity going on out there, and just are wondering, hey, is real estate investing still a thing? Should I wait for this market to crash? That's been a big one ever since I've got into this game. We're going to go ahead and wait for the next crash. We're going to put all this cash to the side. And I did create a totally separate video on that topic. But if you want the short story, don't wait for a crash. There's never going to be the perfect time to get in. In my opinion, we're not going to see another 2008 situation come across our plates again for a long time. The reason real estate was hit so hard in 2008 was real estate was the cause, or a big factor of the cause of the crash, with very poor lending, giving loans out to anyone who could fog a mirror up. And that's just not happening today. So while there's lots of other potential for crazy things going on in the world right now, I don't think, even if we do go into another recession, that real estate's going to get hit as hard as it did in the last time. So we are kind of in this weird stalemate, right? So things are still going up. And again, keep in mind, I'm in the Midwest. And when people say real estate market, I'd almost go out on a limb and say there's no such thing, because there's almost a million real estate markets with an S, plural, meaning every everyone's situation and market is different. So it's hard to give general advice about the real estate market because, you know, it's just not a thing. It's almost like saying how is America's personality, right? Everyone has a different personality, and you talk about this macro thing with thousands and millions of things underneath it. So, but from a general consensus perspective, we can talk about things like the rates, the sentiment, the overall feel, and where things look like they're going. We could talk about overall trajectory. So we are kind of in this economic stalemate where, we're not sure, are things going to keep going the way they have been going, which was on a rocket ship up and to the right, if you're looking at a chart from an investment perspective, or are things going to start to turn around and go back down the other way? And so when I say stalemate, I think we're kind of rocking a little up and down. In my local market, things are still going up, just not as steep of a trajectory curve as we've seen in the past, or as we've become accustomed to. If you've been doing this, anytime in the last 5 to 7 years, I would say you've been really just on the ride of this rocket ship, and really hopefully taking advantage of a lot of the good things we've seen in the market. So I don't think you'll continue to see that level of, hype or appreciation. However, I don't think you're also going to see any depreciation, at least any based on what I'm seeing here. So, gotta get that Friday morning coffee in. All right, so let's start out with talking a little bit about rates. I know rates are a big factor. Definitely have impacted my business this year, or over the last probably 18 months or so, since rates started to pick up. So, like I said, in the last 18 months, we've seen slowly increments, going down from, I think the low was the high twos, very low threes. Don't quote me on that, but somewhere in that range. And now we're up to, I believe the rate is closer to the, I'd say low sixes, high fives. I didn't actually dive into rates this morning before I jumped on. So again, don't quote me on any of that. But the overall idea here is that, over the last 18 months, rates have probably, I'll go out and say, probably more than doubled. Which, if you're in this business and you're constantly evaluating buying deals based on what's going on out there, obviously, rates kind of drive everything that we do. So it's a key variable into how we come up with what we can pay for a property. So, very, very impactful there. So what we've been doing is just evaluating deals, assuming that rates are going to continue to increase. Obviously, it's a slippery slope, because if you think it's going to keep going up too much, then you may price yourself out of deals that may actually turn out to be good deals. But if you, aren't super conservative there, you can get yourself in a bind when you go to refinance out and hope and obviously pay your whatever acquisition cost or fees that you had, whether that's paying back a HELOC, paying back hard money, private money, etc. So the good news here is, I think it was last week, Jerome Powell came out and said that he doesn't expect additional increases, at least throughout the rest of the year. But that also means we're not likely going to see anything decrease either. We're likely going to be in this same environment that we're in today throughout the rest of 2023, which, depending if you're a what's that, half glass full, or I don't know. You know the saying, whether you're an optimist or a pessimist, you can kind of look at that of multiple different ways. For me, I look at that as a positive, of we can kind of stabilize how we're projecting out lending throughout the rest of the year. We know this is the environment we're going to be in, so we can kind of get comfortable here, rather than kind of the uncertainty factor that we've been in the last year or so, where it's, hey, are things going to go up? Are they going to go down? Are they going to go up by 100 basis points, 200? It just that uncertainty factor, I think, made a lot of people step away. And full transparency, we definitely slowed down as well. Just, not wanting to get too aggressive and get too much out in the market per se, when things could get a little dicey, or things, I guess, new news could impact too much of our portfolio, if you will. So, from a rate perspective, that's one of the big questions I was getting from several of you: is what's going on with rates? How's the market looking? Should we still be looking? My answer is yes. I think we should always be looking for deals. always finding ways to talk about real estate. And if you haven't seen already, we did, out of suggestions from the community reaching out to me offline, come up with a couple ideas for some merch. We do got this "I Buy Houses" shirt, kind of the old Supreme-ish logo, if you will. But we do got several of those. You should see those down below if you're interested. But I rock these all around town anytime I'm going out. I think there's an "I Burr," there's an "I" for the real estate agents. We got "I Sell Houses," I House Hack. I think there's one like that. But the whole intent behind these, not to be the coolest shirt in the world, but really just to drive up the conversation. And the whole intent with wearing these is to get someone to open up a line of conversation with you of, oh, you do? You buy houses? What does that look like? What kind of houses do you buy? Oh, I think my cousin, they got this house that they don't know what to do with. And you're like, that opens up the big conversation for you to kind of step in and be that solution for them. And even if they don't have anything active, for you to kind of let them know what you do look for, so that you can be the person that they turn to when something might come across their desk, or a situation comes up that you might be able to help out with. So if you're interested, check those out below. We really don't make anything on those. We just thought that was a cool idea. I wanted them for myself, so I threw them out there, and I created a couple spin-offs for some other niches out there as well, such as the house hacking. I'm not currently doing that anymore, but I highly recommend, if you are looking to get into real estate, and you have to be in a very specific situation, or be willing to get very uncomfortable, if you have a family, situations like that. But if there's a way for you to get into house hacking and you're just looking to get started, I couldn't recommend that strategy more. That's what I've done, and seen so many people hop onto a rocket ship just by doing that, getting into a property with very low down payments, and turning that into a very nice rental in the portfolio there. So that's my thoughts on the real estate market, rates. Talked a little bit about merch, where to get that. Check that out if you're interested. But now let's dive into some of the more situational or HELOC topics. I know a large portion of the audience out there is here for HELOCs, and how do we learn more, how to leverage these HELOCs a little better. So one of the questions we got, who was more situational, that we had to dive into, was, we have someone out there who's looking at, they're purchasing some land that they want to develop, and really turn into kind of this unique Airbnb stay model. So they got this land for what they perceive to be a very good deal, and they thought, hey, can we use the HELOC to go out and purchase this land? Then we're going to build on it and turn it into this model. And at the end of the day, we'll refinance it. You'll do a cash out refinance from that perspective there. And so their other option was, do we go out and get a land loan, go again, get a construction loan, and then at the very end, we'll refinancing and get both of those. So I'll just let you know how I was kind of talking through that situation. Obviously, I think we ultimately ended up deciding that the HELOC was probably the best strategy for that. Being that the construction loan, if you've ever done a construction loan, uh, they're they're a little costly. They're a little they're they're just difficult. There's a lot of administrative pieces. Now, I'm not bashing construction loans. They can be great, depending what you're really trying to get on the other side of, and they may be your only option in some situations. However, a lot of them have draws, which is very similar to hard money, if you're familiar with. But the construction loan, essentially, they set up stages, or stage gates. Whereas, hey, we'll give you, $50,000 to get the foundation poured. I'm not familiar with the whole building process, but whatever the first couple stages are, once you have a good foundation in place, we'll send our inspector out. He'll come make sure that the foundation is sound, it's put together correctly, and then he'll sign off on that stage. Boom, you get then they give you like the check to pay that back off, and then you kind of move into a next stage. Okay, now we're going to front you another $25,000 for framing, wiring, etc. And you kind of move through that cycle, which doesn't sound terrible. However, those inspectors can get busy. I've seen them, be booked several weeks out, and essentially put your construction project on hold until they have availability to come by and sign off on your site. There's also an inspection fee every time they come out to do that. Nothing crazy, but anytime you're doing a construction or a deal in this kind of business, speed is king, and anything that can slow you down from that, it's a hassle factor, just being frank. So I think that was a big piece of it. Anytime you're dealing with a loan as well, there's going to be closing costs factored in that as well. So when he was looking at the land loan, kind of acquiring the land under its own loan, that was going to involve, a down payment and some closing costs associated there. And then we were also going to look at what the construction loan would look like as well. So he would need a little bit of down payment, showing that he had some skin in the game for the construction loan, a closing costs, etc., associated with that loan as well, and then the continued fees, from that piece. And then the crazy part about a construction loan is once you get everything built. Now, this isn't the case for every loan, but at the end, there's a process for ch- kind of changing it from a construction loan to a traditional mortgage. And I've seen even cases where there's closing costs associated with that transaction as well. So essentially getting to the end of construction, swapping that into a formal 30-year mortgage that we're all used to, being charged more closing costs there. So on the other side, I said, hey, look at this HELOC. And they already had one in place. So that was a big thing as well. You could go out and just purchase all of that with a HELOC, get it done as fast as possible because they were ready to move and they had the funds available for, essentially their yearly maintenance fee is all they would have to come out of pocket for, aside from the monthly interest only payments on the HELOC balance that they would use. But they didn't have any administrative headaches to deal with. They could walk all the way through the process as fast as they want. They could choose what they want. They didn't have any third party kind of telling them what to do there. And at the end, ultimately, there's only one set of closing costs when they do a cash out refinance to pay that HELOC back off and get into the long term debt that they want for their Airbnb. So ultimately, that's what they decided for that specific situation. But I thought that process would be helpful to kind of talk through with you guys because that's a very common question is okay, I have the HELOC and I do understand that it's not the best tool for every situation, but and I think a lot of people understand this, but they almost want someone else to kind of tell them and validate that they're thinking about this correctly. And that's perfect. I think in life that's a good practice. Just in general, you don't want to make a big decision on your own and make maybe assumptions that you feel are small but could turn into a huge thing that you didn't consider. So always good to reach out and get advice, especially from someone who's you view has a little more advice or a little different perspective and can help you kind of think through it, walk through it. At the end of the conversation, you're either going to feel more convicted that this is the right path for you, or you're going to learn something you weren't prepared for and hopefully be able to account for that before you get yourself in too deep. So, no problem. I hope to be the resource that you guys reach out to for that validation. And that's kind of the whole goal with this channel. The whole goal with writing the book is to kind of help you guys along the journey, especially with HELOCs. I didn't see anyone really out there doing that. And a lot of good resonation with my videos from this audience, so definitely appreciate that. And just want to kind of continue to be that resource for you. So give me 1 second here. Gotta pump back up the coffee train there. um but on that maybe same topic there, we'll kind of continue that just a little bit deeper. And probably second most common question I get is, you know, the HELOC versus the cash out refinance. What method can I do there? And I know that previous example was a variation of that question, but I did get this question just yesterday. So wanted to maybe at least talk about how I'm thinking about that now, because like we talked about before, the rates going up definitely have an impact on this dilemma or this decision that you ultimately have to make. So when thinking about the HELOC versus a cash out refinance, just a reminder here, if you've read the book, you're probably an expert on this by now, but with a cash out refinance, you are paying for closing costs when you go ahead and go through this process. You're also, as soon as you close on the loan, you get that lump sum amount, that cash out portion of the refinance, of the equity that you had. You get that check at closing, which is the good news. However, the bad news is you start paying for that on day one in your interest payments on that total amount because your loan's now based on that giant amount that's bigger than your previous loan amount. So that's one piece. You're going to be paying for it right away. You're paying for closing costs to do it. And the third big factor is you're getting a brand new interest rate and you're getting rid of your previous interest rate. So, depending where you were and what the current rates are, that's a big factor there. I talked to somebody just yesterday and we talked about, he was in this dilemma. And I said, if you would have called me a year and a half ago, I would 100% told you to cash out refinance because I think he had a five flat interest rate today, and I say, man, a year and a half ago, you could have dropped your rate by 2% and locked that in for 30 years and got this portion that you could go out and invest with and not have to go through the HELOC process. However, today you're going to increase an interest rate, likely, more than a point, and you're going to be starting to pay for that right away. And he was very early on in his journey, just trying to learn the investing principles. So I said, man, I think a HELOC is going to be better for you until you fully understand what you're getting yourself into. Um, so you don't want to be paying interest on that while you're in your education journey. So ultimately, again, I think with rates going up, that only has helped, or I'll say made the HELOC more favorable in more situations because unless you had a very high interest rate, you're going to be jumping up in interest rate to go through the cash out refinance, which still could make sense depending what you're looking at because and I guess one pro still in the cash out refinance. And again, all these are situational here, but if you're going to be using those funds to go out and buy an investment property, your investment property interest rate is going to be much higher than your cash out refinance that you're going to get on your first position primary home. That's going to be yeah, if you read the book, the almost the best rate, and I'll go out and just say the best rate you can get on anything if you're getting something financed is your primary residence and getting that first position lien, right? There's so many government programs. There's just so much incentive for you to have that to have home ownership that so many factors go into making that the best interest rate you can get, the best financial product out there. So all that to say, if you are, debating whether or not, hey, this construction finance on this, fourplex versus what if I took a cash out refinance on my primary residence and then use those funds over there, even if you went up in rate on your primary residence, you're likely gonna that chunk that you're gonna be putting aside for an investment is gonna be much lower than the rate that you're gonna be getting on anything you do on the investment side. So I hope that's helpful there. What's up, David Soto? Thanks for joining us here. Let's see, you got a question. How soon after a Chapter 7 can I apply for a first or second lien HELOC? David, I'll be fully transparent and say that I'm not familiar with the guidelines on Chapter 7 or 13. However, I guess my gut thought is in each of those scenarios, Chapter 7 or 13, I believe there is a period in which you can't purchase a home, or at least you can't get another loan. And so I would say, before you can get a HELOC, you have to actually have a home that you have equity in. So my gut says if you have a home that you have equity in, that means you're probably past your guideline on the Chapter 7 there, and hopefully you can. If someone's willing to give you the money to purchase a home, they should be comfortable also giving you money to access the equity in the home. So that's my gut thought. And full disclosure, I just don't have a whole lot of experience there. I apologize about that. But if I missed something there, or that wasn't helpful, let me know down below. So, but no, appreciate you jumping in there. So yeah, just going back to the cash out refinance versus the using the HELOC. Again, it's going to be completely situational based on your goals and where you're at. But again, higher interest rates have impacted us there. So I know I've been going for a while now. This coffee is definitely getting to me. Let me jump into a couple other questions that folks offline have gotten to me. While that couldn't make it here today. So give me one second here. All right. Okay, this is probably the first most common question that I do get. Is what banks are you using right now? Who's giving out HELOCs? Man, this question, I really, one of my goals with writing this book, I really wanted to be able to give you guys a resource that says, here are the best lenders. Here's, why, here's the whole how. However, what I found was it just changes on a weekly basis. So I put this whole guide together, with contacts. I'm reaching out, trying to build these relationships that I would hopefully hand off to you guys to be able to leverage. But then I'd call back a week and a half later and they're like, oh, yeah, with interest rates and the market, our lending officer decided to put a hold on HELOCs. And so ultimately, my short answer to the biggest question that I know you guys are looking for is I don't have anyone that I can continually recommend on a, all the time basis. However, I don't mind you reaching out. There's oftentimes for particular states, I do have lenders that can do first position HELOCs almost always. So go ahead and reach out. And I'll be honest, if I don't have them, I'll tell you. But sometimes I do. So don't mind you reaching out there. But unfortunately, I don't have a blanket answer or that one size fits all approach. Um, I did drop a video not too long ago. If you're looking for an investment HELOC, through David Green, Bigger Pockets, David Green. I don't know if you're familiar with him there, but his company, the One Brokerage, they're doing HELOCs right now. Not a great product. I'll be honest with you. However, if you're in a pinch, it may be all you have there. So yeah, I hope that's helpful. But unfortunately, don't have that go-to resource for you. Let's look at what else we got. Okay, this question here from Cesar says, "Okay, I don't get how you pay the HELOC off. How does refinancing a home generate funds to pay the HELOC off?" Okay, great question. So when we talk about refinancing to pay back the HELOC, that refinance is a cash out refinance. And so let's say that, okay, you use, let's just say $50,000 of a HELOC to purchase a home. Let's say that it's worth 100,000 when it's fixed up, but it's got all kinds of problems. There's all kinds of liens against it. They basically need to sell this property by the end of the month or else they're getting foreclosed on. So you're able to swindle a deal for 40,000. Now, if you don't like these numbers, you don't feel they're realistic, add a zero to it. If you're out on the West Coast, use 1,400,000. The concept is the same. You're going to buy a property under value using your HELOC. So now we got 50,000, or we bought it for 40. We're going to use $10,000 to clean it up, do a little bit to it. But essentially, we solved the seller's problem. They were in distress. And again, if you're not out there talking to people, you might not feel like this is realistic, but guys, I promise you, if you're out there solving problems, you can find great deals. However, okay, so we took that money, we bought this deal, we fixed it up. Now this thing is worth $100,000, but we have $50,000 tied into it. A bank is almost always willing to lend on 80% of the after repair value, which in this example we said is $100,000. So you're able to get $80,000 loan on this property that you own free and clear because you've just used your HELOC. Now you do have, your $50,000 HELOC. However, it's not tied to that property. I'm kind of going down a rabbit hole here, but essentially take this property to a bank and say, hey, look, I just have, I own this in cash. It doesn't have any liens tied to it. I want to put some debt on it. They're going to tell you they're either going to loan 80%, 70%, 75, whatever loan to value. The point is when they give you that loan, you're going to get a check at closing because it's a cash out refinance. You're taking your cash out. And when you do that, let's say they give us an $80,000 loan against this property, you're going to get a check at closing for $80,000 less closing costs or, whatever, roughly $80,000. You're going to put that in your checking account. And that's what generates the funds there. It's because you didn't have anything tied to the house before. Now you had your HELOC, but again, that's like using a credit card. So it's not when you go out and buy something with a credit card, it's not tied to that asset. It's just tied to your personal name and your personal credit rating or profile, whatever. But so you take those funds that you just put in your checking account, then you pay off the HELOC with those funds, and now you have a free property. So I hope that makes sense. If it didn't, I know Cesar, you couldn't be here this morning, but drop those in the comments. We'll check those out and get you a good answer on that. But want to make sure you understand that. In the book, I did try to outline a lot of people have a problem understanding, and it's not a problem. I didn't mean it that way, but it's difficult to comprehend is a better way to explain it, because most of us go out and buy property as our primary residence. So we understand that process. Okay, I go to a bank, I give a down payment, and I sign on some documents, I make loan payments. That's very normal. If you tell someone that's not familiar that when they go to closing, they get paid, that's a that takes some time to soak in and understand. So keep in mind the process by which you normally close on a home. You're going to a bank. That bank is paying the seller whatever amount you agreed to. They're paying the seller, but really what happens is they send that to the title company. The title company is going to take those funds. They're going to pay off for the seller. One of the things title does is they go out and say, okay, I know they're selling this property, but hey, that property has a lien on it. They have a mortgage on it. So saying that seller still owes 75,000 on that house. So that's good that they're selling it for 150, but the seller doesn't get that 150 and then has to pay their own loan off. The title is going to make sure that that loan is paid off. So the title company kind of they do all your checks and balances, and they're going to say, okay, or the buyer's bank sent me $150,000. That was the sales price of this home. Title's going to say, okay, first we have to pay off that $75,000 that the seller owes before we're even going to allow this property to transfer. Then we're going to give the seller everything that's left of that. So in that scenario, the seller would have gotten 75,000. So in a somewhat similar situation, when you cash out refi, even if e- l- even if that same situation happened, but let's say that seller, the property is worth 150, he only owes 75. Instead of selling it, he could have cash out refied, where a bank would have been willing to give him that money. Title would have said, "Oh, okay, you're gonna take a new loan out for 150, but you only owe 75. We got to make sure that lien's paid off." So they pay that off, and then that seller would have gotten the difference, would have been able to keep their home and continue to make payments. So look, I know it's kind of in the weeds, and if you don't do this a lot, it can be confusing there. But I did try to leave a good, I built a good graphic for this in the book. If you haven't checked it out, again, it's Unlocking Millions. We're out there on Amazon, anywhere you can buy books. And guys, this is it for me. I mean, I don't have a course tied to it. This isn't a insert into my funnel program. I don't have anything to sell you aside from the book and aside from the merch that we just came out with. And again, I literally make less than $5 on each one of these. Um, if you're not familiar, Amazon does put minimum price points on certain things to keep competitiveness on the site and certain categories, etc. So I try to make it very cost effective to do that. And they just, as soon as I wrote the book, depending how you look at things, I thought it was kind of just funny. I try to look at everything through that lens. They did actually raise their printing cost. For the book. So we're now making a little bit less than we even were before there. So, all right, guys, we'll get to wrapping up here just in a minute. If you haven't done so already, if you are stopping by in the past, go ahead and drop a like below. That kind of just tells YouTube that, hey, this might be relevant to somebody else hopping in, or to someone else who might have questions. Let me get to, let's see, one or two more quick questions, and we will call it a wrap today. So, let's see. Find a good one here. All right, let's try this one. I haven't read this one yet. Hey, Tyler, I want to buy my first home and do the Burr method. I was wondering if I should start with a very expensive house with a more affordable house to do the Burr method. Right now, I have a opportunity to buy a 200 or $380,000 home. What should I go for to have more capital in the future? Let me make sure I understand that. So he wants to buy his first home Should I start with a very expensive house or with a more affordable house to do the Burr method? Looks like he has an opportunity to buy either a $200,000 house or a $380,000 house, and he's not sure which one. I want to make. What should I go for to have more capital in the future? Uh, I don't know if I fully understand this question, but I'm going to make some assumptions here just to kind of keep to make sure we at least get some thoughts out there for you. So if you're up in the air between two properties, let's see. If I was in your shoes and I had two different properties, I don't know that value would be a factor for me in considering which one to purchase. If I have 2 and I have to pick one, I think I'm just gonna run my numbers. I'm gonna look at some of the more subjective, pieces of the deal. Well, I don't know if subjective is the right term, but I'm gonna look at some of the more factors of what my buy box is. What are they both in the same type of neighborhood? Are they, is one in an A class neighborhood, one's in a C? Is one gonna kick off more per month? What does that, overall return look like? I think I'm gonna keep it purely buy box criteria related. And I guess just what I mean by that is I want to run my numbers like I would on any other deal and choose the deal that best fits into what I do. I don't think I don't think the value is going to change my opinion a whole lot unless these are both smoking hot deals and you have the same percentage of upside on both of them, which is very unlikely. Then ultimately, I guess I'd go with the higher value one because on a percentage basis, that outcome would be much better. That's usually not the case. So yeah, if I misunderstood your question, drop it below and drop me any additional info that might help with that. But yeah, I don't know. I feel like I butchered that one for you. So hopefully not. But good luck to you if you're just starting out doing your first burn method. Um, and I guess one more piece there. If it is your first one, you may want to lean on the lower end because you're probably going to screw up some things. Nothing against you, but we all do it. So it's better to learn those lessons on the cheaper deals. But again, I don't think I don't think I can say that purchase price would be a factor for me on the Burr method. All right, let's see here. Okay, look, Steven Burton, I appreciate you hopping in here, man. Let's see what you got. I have a group of friends that are all interested in getting into real estate investment and are ready with money, but can't seem to pull the trigger on getting started. What tips do you have? Hit hit enter too soon, but what tips do you have for a new group with limited knowledge? Let me just read that again. Group of friends that are all interested. And with money. So I'm gonna assume, and just correct me if I'm wrong, that you guys aren't putting all your money together to buy one deal, but you guys all collectively want to get started investing, and you just want to, I guess, as a group, start to be thinking about the right things or right tips. So if I don't have that right, correct me down below. But yeah, my tips for, um, putting money together to do a deal. Okay. Mm, a lot more tips than if that's the case. So there's a lot. If you're going to be doing a partnership, I think it's really difficult, especially, and I think it compounds with the more people that you insert into that partnership, the amount of problems just compounds as well. However, if you've kind of worked through that, these are good partners. You've kind of done all the due diligence from that perspective. I would start to, I'm assuming if there's that many people, you need to be buying probably a deal big enough that it makes sense and it kicks off the kinds of returns that are, give an appetite to several people. So you're probably looking at the multifamily or commercial space. I doubt a single family, rental is going to be enough for several folks to really kind of eat off of or be worth your time. You can probably create better returns elsewhere. So, but if you're going for something bigger, you're going to take down a bigger deal. Most of those deals are traded off market via brokers in your area. So if I were you, I'd be first of all networking with brokers and really starting to specify what your buy box is. Is this going to be we putting our money together to buy self storage? Do we want a multifamily apartment buildings? If we do we want a 15 to 30 unit? Do we want a 50 to 80? Just kind of really starting to hone in on what you really want to purchase so that when you talk with a broker, they're not just thinking you're like everybody else who has an idea, wants to get into real estate, but really doesn't have a solid plan. So I think first, kind of getting, I think Brandon Turner calls it your crystal clear criteria, really what you want there. And let's see, you have the money, but can't seem to pull the trigger on getting started. I'm just making sure I remember back to your original question. Um, so yeah, I think often folks getting the money is the big hurdle. And so once you have it, it was funny. I actually run a local meetup and I had somebody join it and they were like, hey, I've been saving money for all these years. I finally have the money and I'm ready to dive in. So just show me what to do. And we're all like, man, yeah, that's only half the battle is coming up with the money. But a lot of people wouldn't think that. So really to find a good deal, uh, I'm almost just going to go out on a ledge and say it almost has to be off market. You're very unlikely that you're going to find something on market that generates any kind of above average return. However, you can, I guess, make a deal that's on market. Let's say, you see a commercial property out there that somebody's operating it improperly or it has a higher and better use. You could add a unit, you could do some value add there. That's probably going to be the only situation that you could find something on market that would be relevant. But yeah, so for that instance, I would say go off market. In addition to networking with brokers, I would also kick off some kind of outbound marketing, whether that's direct mail, cold calls is difficult in that asset class for commercial. But I'd say more of a maybe a personal. If you can start to build some personal relationships, figure out who owns a lot of properties in the areas you're looking at, and see if you can somehow get connected with them. But yeah, let those ideas run. But in a sense, you need to get off market to try to do that. And let's see what else. I'm going back to your question here. Really can't seem to pull the trigger. And then I'll just say one last thing. If let's say you've had a couple good deals come across your desk, and maybe a couple of you are just a little hesitant on if it's pulling the trigger that is the um, I guess is the friction point for allowing you guys to move forward. Assuming you've kind of done the other two things that I mentioned, and just pulling the trigger is the problem. I would say, man, just to have some honest conversations and talk about what exactly you guys are truly looking to do, and the why behind that. Maybe look a couple years ahead and say, hey, this is what we all want. Is real estate the right tool? And if so, hey, the next thing that checks these boxes, try to keep it objective. This is our buy box. We've checked these three boxes. And if you're not ready to pull the trigger, then hey, we're gonna, you're kind of out of the group, or we're gonna keep this group down a little bit, and for people that are ready to dive in and take action. So I know a lot of that's probably just general advice, but really not understanding exactly where the friction point is and what you guys are hoping to do. Those are my initial thoughts. So I hope that's helpful, man. But I appreciate you dropping in nonetheless and hanging out here. I know I have ran a little bit over time, so we'll get wrapped up here in just a minute. Wanted to circle back to one more note I got. Offline, and let me find it. Got too many windows up here. All right. Okay, let's hop into this one. This will be our last one. This is Mr. Hayago. You take out a HELOC on your current residence to use that line of credit toward a rental property. What ways do you pay off that HELOC balance? Okay, great. This is one of my favorite things to talk about too, because it can get you in a rough situation if you're not prepared for it. So actually using a HELOC for a down payment, and then what kind of is the conundrum there. So you go out and do that. So now you have a property that you have debt on, and you also have, and hopefully it's cash flowing, right? But then you also have a HELOC that you have to make monthly interest only payments on. And so how do you ultimately get that paid back off? So a couple things here. Y- This strategy is something I never recommend for beginners. It's very difficult to make this work out, to just use a HELOC for a down payment because you're essentially 100% financing a property. And unless you got a smoking deal, the 100% financing rarely gives you enough return to make that profitable. And if it does, it's likely going to take you probably 5 to 10 years to get that thing paid back off. I do give a whole example in the book there about why I don't do that and some of the math behind that. But let's say you are in that situation. You've bought a property with a HELOC and you're trying to use the cash flow to pay it off. Maybe that's kind of the first strategy. If you think that that thing spits off enough cash flow plus your discretionary savings that you have on a monthly basis can get that thing paid off in maybe 2 years, I would go out, then go with that strategy. 9 times out of 10, that's not gonna be the case. It's gonna be beyond 2 to 3 years. In that scenario, I'm gonna start to look at what kind of things I can do to either get this property value increased so that I can cash out refinance and use those funds to pay this back off, or I'm gonna look at, "Man, did I get in over my head, and do I need to look at selling this property?" Um, if you've done this in the past couple years, you're likely in a good situation where the market has appreciated and saved you or given you some wiggle room. You can likely sell and make a little bit of money and kind of learn your lesson. Like, hey, that was probably not a smart move there. Um, so those are kind of the first three waves in which I look at this, and I talk about this in the book as well. Ultimately, if you're stuck, those couple things don't work for you. Your last step is that you can sell your primary residence that the HELOC is tied to. So I know that's never fun. It's never an easy conversation to have with your family that, hey, we need to sell our home because I got us into some investment trouble. So that I always try to make sure that folks understand the risk associated when you use a HELOC. You are putting more risk. You're tying that investment decision to your primary residence. So you want to make sure you really think through that and you aren't putting your family in a tough situation there. So, but the good news is you do still have an option. You can likely sell your home, take the funds. You likely have a good equity position in your home, or you wouldn't have gotten the HELOC in the first place. So you can sell your home, take that equity to then pay off your HELOC. Likely going to sell your rental property too to pay off, that, and you're going to be starting from scratch. So that's kind of the worst case scenario. But the good news I always try to say is, hey, bad news doesn't get better with time. It doesn't get better by chance. There is the positive light is you can take action and get yourself out of this bad situation. There's rarely a situation by using a HELOC where you're actually fully stuck and you need to go into foreclosure or bankruptcy. Unless you're out there buying liabilities or just making horrible decisions. If that's the case in general, you're probably going to likely end up there anyway. This probably just fast tracked it for you. So, guys, we'll go ahead and wrap with that one. Really appreciate you guys dropping by today and hanging out. If you're watching this in the future, let me know if these are any value to you at all. We're kind of just trying something out here and seeing if this resonates, if this is a good opportunity for you guys or for me to engage with you guys and give you real time feedback on any situations or problem you're going through. And the ability to do this at scale or by kind of doing it once and letting all of you guys hear the benefits is my really whole goal with this. So with all that being said, if you got any value from today's session, hit a like below. That's a free way to support the channel. If you are looking for paid ways to support, super chats are down there in the comments below. But again, guys, that's not why I do this, but several of you have asked, so just dropping that there for reference. But I hope you guys have an awesome rest of your Friday, amazing weekend. And with that, guys, I'm Tyler Wayrung, and we'll catch you next time.